Hey, what's up, everybody? Ready to go, and I'll see if anybody tunes in. So today we're going to talk about how to develop your financial plan. One of the common things that is hard to really know is where you're going when you don't really have a clue what the ultimate goal is. So I'm just tagging some people real quick so they know that we're doing this. Give me 1 second. All right. So, developing a financial plan, first thing you got to do is actually come up with your financial number, right? So, your retirement number. You're going to want to have a pen and paper because we're going to come up with this and we're all going to develop one if you're following along, right along with me, okay? Every couple months or every time you have a change in your financial status, you got to develop or relook at your financial plan. It's important because at the end of the day, look, when you're a minority or you grow up poor, more than likely you're not going to have access to a financial advisor, right? I talk to advisors all the time because I'm very interested in finance and I try and do a lot of business in that arena. So I hear these things, right? If you are not an accredited investor, they tend to not deal with you. An accredited investor is somebody that makes over $200,000 a year, right, for 2 consecutive years, or has a net worth of greater than $1 million, or has demonstrated that they have shown potential to get a high return on their investments, right? So you have to demonstrate your ability to do these things. But an investment plan or a financial plan is really important, right? Because we have to sort of help ourselves, right? Financial planners, financial advisors, they don't make a lot of money off of people with low assets, right? The industry's changing a little bit and they're going to a fee only model in general, in theory, right? Not everyone has really bought onto that, but right now, majority of, I shouldn't say majority, a lot of planners have a 1%, or some type of assets under management model. So that means if you have $100,000, being managed by a financial advisor, they're going to eat into your return. So if you're getting, let's say, just 10% per year, $10,000, well, some of them might take $2,000 of that 2% every year, and that goes up, right? That's how they make their money. Okay, so developing a financial plan is one of the things that they're going to do with you, okay? And it's really something simple that you can do for yourself, right? 80% of us don't need to have complicated financial plans in order to reach our financially independent number where we can retire early, right? First thing you have to realize is, and unfortunately it takes some math, right? But there's a lot of calculators out there. There's a calculator on your phone. 4% is the max number of, or max percentage that you can do what's called a drawdown of your retirement account, right? So 4%. So if you think about how much money you think you're going to need in retirement, let's just say it's $50,000 a year. That's pretty low, right? If you have kids, but or that's even better. Let's say $100,000, right? So if you multiply that by 25, right, that will give you an idea of the total amount of money that you need in order to retire early, right? Because only 4% you can withdraw without taking a tax penalty. Okay, so those numbers are important, right? And make your number higher than what you think you need it, right? Because if you don't reach that goal, you're still going to be way over the number that you want it to reach. So first things first is you got to write down your purpose. Why are you doing this? What age are you retiring at? Okay. What is your whole goal to retire? Why do you want to retire? Right? You don't have to. You can retire and still work and make some income and keep yourself up. My personal thing is I want to retire from being a surgeon full time at the age of 65. Why 65? Well, I feel like I can still go back to school and do what I really want to do, which is get a PhD in applied mathematics or applied physics, because I'm a nerd at heart and I really like math and I really like physics, and I really would like to be able to learn that a little bit better, maybe contribute to the academic side of the house. But the reality is I did grow up poor. I basically started with nothing, and I refuse to let my family and the generations following me leave with nothing. So my thing is when I look at my purpose, right, this is the same thing as doing a vision board. Your financial plan is your financial vision board, right? The first purpose is to retire for me at 65 years of age, all right? The reason why I'm doing it, so reason is the next category, right? You got to write down your reason, all right? For me, it's because I want to become financially independent, right? To build generational wealth for my family. And then I want to go back to school and get my PhD, right? So the next thing that you're going to write down is, what is your net worth goal, okay? Again, this is where that retirement number comes in, okay? The higher it is, right, the 4% drawdown, if you're gaining in that money, if you're gaining, let's say, a paltry 7% per year and you're only taking 4%, guess what? You're still making money, right? Because there's a 3% difference between the compound interest that you gained minus the 4%. So you're still it's going to snowball. So the higher the amount, it's going to snowball very fast. Think about it. If you only have $1,000 invested, but you're getting a 10% interest rate, right? That means there's $100 there. If you have, if you have $100,000 invested, you have $10,000, right, from 10% interest. The higher that number, the more money you get, right? So that's why we have to raise that number up. Okay, so the amount to invest. This is very tough, right? So the easiest way to figure this out, okay, because this is going to be the amount that you want to save or invest per year in order to reach that number, okay? The easiest way to figure this out, okay, is to take that number that you think you might want to retire on, okay, let's call it $100,000 a year if you have a family, right? And you multiply that by 25, okay? So that's going to get you to where you want to get to, okay? So if it's less than that, okay, and if you remember, if we do some quick math, right, that's going to also tell you how quickly you can retire. So if you have $1 million in your retirement fund, right, and you're trying to retire, and you know you need to live on $50,000 per year, okay, then you have 20 years that you can live off of that money, right? In theory, with gaining zero interest while it's actually invested for you, okay? So 50,000, right? So now if you're going up to 100,000, okay, you got to double that, okay? So that means you need 2 million, okay? And it's so on and so forth. This is the easiest way. When I'm even thinking about the interest, that's the easiest way to think about it, okay? And the earlier you retire, the higher the number or the lower the amount that you need to live on. So the first thing first is, as we talked about before, as I wrote in multiple articles, you got to sort of decrease your expenses, okay? So if you're making $6,000 a month, right, pre-tax, 20% of that needs to go into a savings or investment vehicle. The easiest way to do that is to maximize your 401k, 403b, 457, whatever, TSP, whatever's your retirement plan at work. You need to go ahead and maximize that. For a 401k, 403b, 457, the maximum amount you can contribute is $19,500 per year. Okay, that is tough to do, right? It's absolutely tough to do. It's a lot of, admittedly, it's well over $1,000 something, right? For some people, that might be 20%, and that's just fine. Okay, if that hits your 20%, you're golden, right? You're absolutely golden. Okay, you don't. In reality, you can just do that. Be aggressive in your 401k if you're younger, and start to throttle back after you get above 50 years of age to get less risky. But the reality is, you can get pretty far with just that, right? You can easily become a millionaire, right? A multimillionaire on $56,000 a year. That's the lowest amount you need to make, right? If you do this correctly to become a millionaire at retirement. It's the 100% truth. $56,000 a year. So if you're making more than $56,000 a year currently, you have no excuse not to be a millionaire when you retire. Okay. So your amount to invest, what you're going to do is come up with a number that you need to, okay, you need to retire on and live on, and multiply that by 25. Okay. That's going to be the total amount that you need at retirement, and then that's going to be your target. It should be ideally 20% of what you are making per month or per year. Okay, your time frame. So I set my first withdrawal at the age of 65. This is where you come in. If you want to retire at 55, then say, hey, my first withdrawal needs to be at 55 years of age. Okay, and then you can also go back and like, hey, actually the amount that I'm planning on saving and investing is not enough. I need to increase because I'm retiring early. Okay, so your risk level. Okay, this is where you start to delineate out, right? So the different risk levels: low risk, moderate, high risk, okay? And then the way you're going to go after it, okay? If my risk tolerance is very, very high, okay? And the reason why is I know the higher the risk, the higher the reward, right? And I'm young and I have a long life ahead of me, hopefully, please God, hopefully, that we have a chance that if we have a financial setback, that I can, as my profession, I know I can go out and make some more money, right? So I can afford to take some risks. Now, if I was 55 years of age and I'm 10 years from retirement, hey, I got to dial back that risk. As of right now, I'm about to be 36. I have a lot of time to really get aggressive in the things that I do. So for me and my wife, our financial plan, so low risk things that we do, right? One is high yield savings, okay? And, or just cash, right? Stacking cash is not a problem as long as you're not stacking cash way above what you need, right? And thank you for everybody being on. Hopefully you're getting some good information, okay? I see you, Dilla, Miss Lisa, Miss Sharice, good to see you. So with that being said, for us, it's low risk stuff like high yield savings, cash, CDs, and bonds, right? Those are pretty low risk. And by bonds, I mean treasury inflated protection securities, TIPS, right? Those are guaranteed by the government. There's as safe as you can get, right? Because the government says, hey, I'm going to back this instrument, right? And they're not going to allow you to lose your money, okay? So those are safe. Your moderate risk stuff is now you're talking about the stock market, okay? So now you're talking about actually investing in index funds, right? 80% of America, in order to get to their retirement number, just needs, in reality, three funds, right? 3 index funds. A total stock market index fund, which covers either the S&P 500, the NASDAQ, or the New York Stock Exchange, or the Russell 3000, Russell 2000, whatever you want to do. Just an index fund, that's one. That's based for the U.S. stocks and U.S. companies. International index fund, which gives you access to emerging markets, and a bond fund. Those 3 funds, right, will do everything that you need to do. They'll get you 8 to 10% per year, safe, don't have to worry about it. You can put it on sort of auto drive and just dollar cost average. And dollar cost averaging meaning you just buy fractional every month, and you can do that through Fidelity, TD Ameritrade, Charles Schwab, whoever you want. Vanguard. I'm a huge fan of Vanguard, a huge fan of Fidelity. I'm also now a huge fan of Cash App, and we'll talk about that in a second. So that's one thing, stock market. Stock market is moderate risk. It's just like you can lose your money, obviously, because the stock market is going up and down. But if we're talking about long-term investing, we're talking about retirement, these are long-term things, okay? So this is different from day trading, right? Day trading is a business, right? And that is speculation. That's akin to gambling, okay? That is high risk, and we'll go into that category here in a second. So high risk, the things that me and my wife, we talk about is owning a business, right? Because you can lose your whole shirt in owning a business, right? It's no guarantee you're going to make any money, but you know that you can scale that business and make a 10-time multiple or whatever it's going to take in order to actually bring some money in. Right? Or you can own a franchise is another way. Rental property and rental property development, okay? Or real estate development. Okay. There are places like in Detroit where you can go to the land bank, right, and buy dilapidated properties for $1,000. You get tax benefits because typically they're in opportunity zones, and you can put money into them, all right, fix them up, and then make them into either a Section 8 house or just a plain rental house, or you can sell them, right? That takes money to make money, right? But the returns can be either from 25% and up, right? If you do it correctly, that's higher risk, right? But it takes you to really sit there and analyze and know what's going on with that property. So if you're going to do those things, there's a resource called biggerpockets.com, right? It has great articles, great forums, and you can sit there and ask seasoned investors. If you don't want to do it yourself, there's things like real estate syndicates, okay, that you can invest in. There's real estate crowdfunding like Fundrise that you can invest in. There's even a concept called mortgage notes. Again, high risk, right? Where you actually own the mortgage of someone's house, right? Instead of the bank owning it, you own it. And again, higher risk, but these things provide a significant return. It's all part of your investment plan and your financial plan, okay? For us, we also have listed master limited partnerships. That's a little complicated for today, so I won't go over it, but just know that's another vehicle that people use to make money down the line, okay? Real estate investment trusts are another thing, okay? So those are things that are on our list, okay? Second, the next thing you need to look at is your sort of investing savings, and really look at the spread on what you can gain. What I do is I'm pretty conservative, so I use a compound interest calculator. You can either go to the website www.surgify.com. In the last article on investing, I put a compound interest calculator, and I'm actually going to move it to a separate link so that it's just there, where I look at if we're investing the amount that we want to invest or save per year, and on a whole across our entire portfolio, we're gaining 5%, 7%, or 9%. 10%. And I look at what that's going to occur, right? I'm 35 right now, so 30 years from now, I want to retire. So I look at the compound interest, which is theoretical, and I look at the spread for what we can do, right? So if I'm aggressive, I'm going to hit our number. If I'm sort of timid and not really getting after it, then I might not hit that number, but I'll definitely be over the number that we technically need, okay? All in all, right, that's your financial plan, right? Now you need to talk about how do you do this with your budget, okay? So how do you get there with your budget? How do you figure out what you're going to need and how you can cut back? First things first is you need to know what type of spending you have, okay? Go back and pull the last 3 months of your checking account or your primary bill spending account, and you need to look at what comes in versus what's going out, and how much money you have at the end, and how much you're saving, okay? There's gonna be a plus column, there's gonna be a minus column, okay? And go through it, and you need to audit it, right? And actually see and write down the categories, and do it by hand, or use a tool like Mint or Personal Capital, which will do these things for you, and you just have to change the categories around, and you need to actually see where you can save money, okay? And then you know what your number is for 20%. You gotta move the board around, the pieces on the board around to get to that number, okay? Once you have that budget in, you need to revisit it every month, every other month, on a regular basis. If you get an increase in your salary, if you get a decrease in your salary, you need to revisit your budget, and maybe you might have to cut back. Like, do you really need Disney Plus, Hulu, Netflix, and all these streaming services that you only use so often, right? Do you really need the top of the line cable, or do you really need the top of the line internet? Do you really need to drive a car that's $1,000? Do you need to, is it possible that car is, or you're not really getting enjoyment from that car, it's just the status symbol that you're getting from it? So you got to really ask yourself this. Once you got all that done, okay, now your budget's set, right? You have a plan and you can push forward. When going forward, you're going to have to sort of change some things that you do in order to make sure you meet your numbers, right? So every time you have a change in your financial status, you add a kid, All right, a kid goes off to college. You have to really prepare for these things. The other things that we didn't talk about and incorporate in a financial plan is making sure that you know how your kids are going to pay for college. As minorities, we get sort of thrown to the wolves and say, hey, when you're 18, bye-bye, you got to pay for college on your own. I don't necessarily agree with that. If you read the book, The Millionaire Next Door, a commonality across all those classes is the millionaires pay for their kids' education, right? And that's important, especially in this day and age. Now, education does not have to be college, right? It can be a trade school. There are electricians and plumbers and carpenters in this country who make more than doctors. That's just flat out, right? Flat out. They don't have the student loans, and they don't have the headache, and they get started earlier with their career. And they do very, very well. Okay. So don't knock trade schools. Don't knock being an auto mechanic. Don't knock being a barber. Have a great business sense. So if your kids have a plan, right, and they know, you know, the plan and you know what they're going to do with it, they can take the money that you put away for college. Hey, UTMA account, right? It doesn't have to be a college 529, right? A UTMA account is just a regular trading account that you can use and trade under your name. And then when the kids become 18, it becomes their money, provided they've done the right things, right? So that money can be used for anything, starting a business, right? Going to trade school, buying their first house as a down payment, right? That is a game changer. If a kid is able to buy a house at the age of 18 instead of living in some random apartment for a couple years, for 10 years, let's say they don't buy a house till they're 28. And on average, they've been paying $1,000 a month for rent, okay? Think about that. For 10 years, they've been paying $1,000. That's $120,000 that they could have put into a house that you gave them the down payment for. That house would be paid for, and then now they have equity built up into that house. That is generational wealth. That changes lives right there. Absolutely changes lives. That provides financial freedom for your kids. So just remember that. Even if you're starting now, your kid is less than a year old, and you put $25 a month away, right? You're going to hit, and you get a paltry return of 5 to 7%. You're going to hit $15,000 by the time they turn 18. That money is a game changer. I left home with the clothes on my back and underwear. Barely that. Not even going to lie, okay? That is an absolute game changer, okay? So I'm going to leave it at that point. I hope everyone learned something today. I hope that I was able to help you out in developing your financial plan. If you have any questions, please hit me up. As always, pay attention to the blog, pay attention to the Facebook group. I'm happy to be in this community with y'all. If you think this information will help someone else, right, please invite them to the community and invite them to join the group, because every day we're going to talk about something new, right? Or we'll talk about an article, or I'll bring up a fact that we need to make sure that we're paying attention to, okay? And then in the next couple of weeks, I think we're going to go over side hustles, right? And I really want to bring my brother on here, Jonathan Williams, who's in the community. He developed a side hustle doing his own Amazon fulfillment business, and he's very successful at it. And he's very, very analytical, and he has a whole process that he's developed. And matter of fact, you probably brought one of his products without even knowing it. But I mean, in the last couple months, he's done over, I want him to tell how he's done over 1,000 sales in the last couple months. And that provides a side income that is passive for him. He does a little bit of work, and bam, it's off and running. Amazon runs it for them. Those things are important, okay? Side hustles, multiple streams of income. There are things that you do that you're talented at. And I see Erica online. Hey, Miss Designer, talented at to develop a side income, right? Those are important things, okay? Financial independence is not gained easily, but we can all gain it, okay? No matter if you make $20,000 a year, $50,000 a year, $100,000 a year, whatever you make, you're going to get there. I'm going to help you get there. And as a community, we're going to get there because we're going to network. If everybody's good with that, I will always have your back. Talk to you later. Peace.